Silver has occupied an awkward space inside institutional portfolios, treated as both a monetary relic and an industrial afterthought, and that tension is now re-emerging at a moment when price behavior is no longer aligning with conventional explanations, leaving one unresolved question hanging in the background. Recently, the price action itself has become the first signal, not through explosive moves, but through persistence, as silver continues to hold levels that historically triggered aggressive selling, suggesting that the usual pressure points may not be functioning the way they once did, which raises a quieter but more unsettling possibility. Behind closed doors, analysts who normally frame silver as a secondary derivative of gold have begun to change their language, not publicly, but in internal notes, where references to temporary dislocations are giving way to phrases that imply structural strain, hinting that something beneath the surface may be shifting. What stands out is how John A.G. has approached this moment, not by forecasting dramatic targets or framing silver as a speculative rush, but by focusing on what the market is failing to do, especially during periods when selling should have accelerated, but instead stalled, a behavior that rarely appears without consequence. At the institutional level, silver's dual role complicates interpretation because industrial demand narratives and monetary hedging arguments often cancel each other out, yet recent trading patterns suggest neither side is fully in control, leaving price discovery suspended in an uncomfortable middle ground. One subtle detail John A.G. emphasizes is how volatility has compressed even as interest grows, a combination that historically precedes decisive repricing, not because of excitement, but because available liquidity becomes less responsive at critical moments, setting the stage for an imbalance. The broader macro backdrop adds pressure without providing clarity, as tightening financial conditions and geopolitical uncertainty normally strengthen the dollar narrative against metals. Yet silver's relative resilience complicates that assumption and challenges the standard playbook institutions rely on. What makes this phase particularly difficult to dismiss is the absence of a single headline catalyst, because when markets move without obvious triggers, it often suggests that positioning, not news, is doing the work, and positioning is rarely visible until it breaks. Taken together, the behavior John A.G. is dissecting doesn't point to inevitability or certainty, but it does imply that the next move may not be driven by retail enthusiasm or speculative leverage, which leaves a far more consequential question unresolved. Historically, when a market begins to ignore signals it once obeyed, the explanation is rarely found in price charts alone, and that is where John A.G.'s analysis becomes more unsettling, because it shifts attention away from momentum and toward the mechanics of supply, which quietly define how far any move can actually go. One of the earliest stress points appears in how physical silver availability is discussed versus how it trades, as reported inventories remain technically adequate on paper, while delivery timelines and sourcing behavior tell a more cautious story, suggesting that the visible data may be lagging the lived reality of participants. What John A.G. keeps circling back to is not shortage language, but friction, the kind that shows up when metal can be found but not easily mobilized, a condition that doesn't trigger panic but steadily erodes confidence in the system's flexibility, especially among larger buyers. This matters because institutional buyers don't respond to headlines the way retail does. They respond to execution risk, and when execution becomes uncertain, even slightly, it forces adjustments that rarely happen all at once, creating a slow migration in positioning that looks insignificant until it's not. There's also an underappreciated asymmetry forming between futures pricing and physical commitments, where paper exposure can be adjusted instantly while physical obligations cannot. And that mismatch has a way of surfacing precisely when volatility seems unnaturally low. John A.G. points out that this isn't about claims of manipulation or hidden hoards, but about how modern metals markets are optimized for efficiency, not stress, which works perfectly until conditions demand redundancy, something the system doesn't naturally carry. Another layer emerges when looking at who is no longer selling aggressively, because the absence of expected supply from certain participants can be more informative than new demand, implying that risk managers may be reevaluating assumptions that once felt safe. What's notable is how these changes don't require dramatic buying to matter, only a refusal to meet bids at previous prices, a subtle shift that gradually forces revaluation without triggering alarms, until the market realizes it has been repricing all along. John A.G.'s restraint in framing this phase is deliberate because once a narrative solidifies publicly, the opportunity for careful positioning disappears, leaving only reactive behavior, which is rarely how institutions prefer to operate. If these frictions continue to accumulate without resolution, the question stops being whether silver is cheap or expensive and becomes whether the current structure can absorb even modest shocks, a question that hasn't been answered yet. At the institutional level, the most revealing shifts often occur not in what is added to models, but in what is quietly removed, and John A.G. has drawn attention to how certain long-standing assumptions around silver's responsiveness are no longer being treated as reliable inputs. One of those assumptions involves correlation, particularly silver's tendency to follow gold or the dollar with a predictable lag, yet recent periods have shown that relationship weakening at precisely the moments it would normally reassert itself, implying that external drivers may be losing priority. What replaces correlation when it breaks down is behavior, and behavior is harder to quantify because it reflects constraint rather than preference, suggesting that some participants are acting not because they want exposure, but because they can't exit or re-enter without consequence. John A.G. highlights how risk desks are responding by shortening time horizons, favoring optionality over directional conviction, a defensive posture that doesn't suppress prices outright, but reduces the willingness to provide liquidity when it's most needed. This has a cascading effect because thinner liquidity amplifies small imbalances, making routine flows appear outsized and feeding the impression of strength even in the absence of new information, a dynamic that often goes unrecognized until it accelerates. Another pressure point appears in hedging behavior among industrial users, where forward coverage is reportedly becoming more staggered rather than concentrated, a sign that certainty about future pricing windows may be eroding. The significance here isn't volume, but timing, because when hedges are spaced out, it reflects a desire to avoid committing too much exposure to a single price regime, a subtle admission that the current range may not hold. John A.G. is careful not to frame this as a bullish signal in isolation, because the same dynamics can reverse under stress. But he notes that reversals require participation from sellers who are increasingly selective. What's emerging is a market that moves less on conviction and more on constraint, where participants adapt to limitations rather than express views, and those environments tend to remain stable until they don't. If this shift in behavior continues, the next catalyst may not arrive as a headline or policy move, but as a moment when routine activity suddenly produces an outsized response, leaving little time to adjust. For decades, silver has been framed as a reactive market, one that responds after forces elsewhere have already taken shape, yet what John A.G. is describing suggests a reversal of that order, where silver begins to signal stress before it is formally acknowledged. A key element in this shift lies in how spreads are behaving across related instruments, not widening dramatically, but refusing to normalize, a condition that implies persistent imbalance rather than transient volatility. John A.G. draws attention to the quiet recalibration happening among intermediaries, particularly those responsible for smoothing trades, as their tolerance for inventory risk appears to be narrowing, even as demand remains steady. This narrowing doesn't shut markets down, but it changes the texture of trading, making price movements feel heavier, slower to retreat, and harder to fade, characteristics that often precede repricing events rather than speculative surges. Another subtle indicator emerges in how rallies are being treated, with less urgency to sell into strength and more emphasis on preserving optionality, a behavior that suggests participants are unsure whether higher prices represent excess or adjustment. The backdrop here is important because macro conditions alone don't justify this restraint, which implies that the hesitation is coming from within the silver market itself, not from external fear or enthusiasm. John A.G. avoids labeling this as a turning point, but he notes that markets rarely telegraph transitions clearly, and when signals do appear, they tend to be dismissed as noise until they align too tightly to ignore. What complicates interpretation is that none of these changes require new buyers to push prices higher, only a collective reluctance to reassert old levels with confidence. This reluctance creates a fragile equilibrium, where stability depends on nothing going wrong, and in markets that is rarely a durable condition. If that equilibrium is disturbed, even modestly, the response may not resemble past episodes, raising questions about how quickly the market could adjust once it's forced to. Historically, when markets enter this kind of equilibrium, attention shifts from price to flow because it's the direction and persistence of capital that determine whether restraint hardens into resolve or dissolves under pressure. John A.G. spends time on what isn't showing up in public data, especially the absence of aggressive short re-engagement despite levels that once invited it, a silence that suggests prior strategies may be under review rather than confidently redeployed. This matters because short positioning has long acted as a release valve in silver, capping rallies and restoring range-bound behavior. And when that valve tightens, the system behaves very differently even without new demand. Another layer emerges in how capital allocators are framing silver internally, not as a trade, but as a hedge against operational risk elsewhere, a subtle shift that changes how long positions are held and when they're reduced. That framing doesn't require conviction about upside, only discomfort with alternatives, and discomfort tends to persist longer than enthusiasm, especially in environments where macro signals conflict rather than converge. John A.G. also points to timing mismatches between capital inflows and market depth, where even modest allocations arrive during periods of thin participation, producing price effects that feel disproportionate to their size. This creates a feedback loop that's difficult to model because the impact of flows becomes dependent on when they occur rather than how large they are, increasing uncertainty around execution. What's striking is how little of this shows up in traditional indicators, which continue to imply normal conditions, reinforcing the risk that participants relying solely on those measures may be reacting to a market that has already moved past them. The longer this divergence persists, the harder it becomes to reassert old frameworks without incurring cost, which is often how structural shifts solidify quietly. If these dynamics continue to layer without interruption, the next phase may force participants to choose between adapting early or adjusting abruptly, a decision markets rarely announce in advance. Behind closed doors, the conversation begins to shift once participants stop debating direction and start debating exposure, and that distinction is central to how John A.G. frames the current moment in silver. Exposure is less about where price goes next and more about what happens if assumptions fail. And in silver, the assumptions around liquidity, substitution, and responsiveness are being tested without a clear resolution. One pressure point emerges in how alternative sources of supply are evaluated, as substitution narratives appear less persuasive when timelines stretch and costs fluctuate, reducing confidence that higher prices can be easily arbitraged away. John A.G. notes that this doesn't imply scarcity in the dramatic sense, but it does imply rigidity, and rigidity is what transforms ordinary demand into market-moving demand under the right conditions. Another element is the way options markets are being used, not to express bold directional views, but to manage uncertainty around sudden repricing, a signal that participants are hedging scenarios rather than expectations. This behavior tends to precede periods where outcomes diverge sharply from consensus, because consensus itself becomes less relevant when participants are preparing for multiple paths. What's notable is how little public commentary reflects this shift, as surface narratives remain anchored to familiar explanations, masking the quieter recalibration happening underneath. John A.G.'s caution comes through in how he avoids forecasting timing, emphasizing instead that when markets move due to structure rather than sentiment, they often do so without warning and with limited opportunity to reposition. The implication isn't inevitability, but vulnerability, where the system's ability to absorb stress is narrower than it appears, even if nothing has yet forced the issue. If that vulnerability is exposed, the market's response may not be explosive, but it could be persistent, altering baselines rather than producing spikes, a scenario that's harder to trade and harder to reverse. At the institutional level, the final phase before repricing is often marked by normalization of the abnormal, and John A.G. suggests that silver may be approaching that stage, where conditions that once felt temporary begin to feel routine. When participants stop expecting reversion, behavior changes quietly, as strategies designed for short-lived dislocations are replaced with ones that assume persistence, reducing the urgency to correct price deviations. This shift can be seen in how benchmarks are referenced internally, with recent ranges treated less as extremes and more as working assumptions, a subtle but meaningful adjustment. John A.G. points out that this doesn't require agreement across the market, only enough participants acting on similar constraints to change the aggregate outcome. As these adjustments accumulate, the market becomes less sensitive to familiar signals, making interventions that once worked feel delayed or ineffective. What complicates matters is that this phase often appears stable from the outside, encouraging complacency, even as the underlying structure becomes less flexible. The risk here isn't sudden collapse or runaway prices, but misalignment, where expectations lag reality just long enough to amplify the eventual correction. John A.G. emphasizes that markets rarely correct in ways that feel fair or orderly when structure, rather than sentiment, drives the move. If silver has entered this stage, the next development may not announce itself with volatility, but with a quiet shift in what the market accepts as normal, leaving participants to adjust after the fact. Historically, the most consequential moments in commodity markets are recognized only in hindsight, and John A.G.'s breakdown suggests silver may be moving through one of those periods where significance is defined by accumulation rather than action. By the time repricing becomes obvious, the behaviors that enabled it are already entrenched, making reversal costly and resistance uneven, especially for participants anchored to outdated reference points. John A.G. frames the current environment as one where patience, not prediction, becomes the defining variable, because structural shifts rarely reward those waiting for confirmation. What stands out is how little needs to change from here to alter outcomes, as stability itself becomes a catalyst when it discourages defensive participation. This creates an asymmetry where downside reactions may be absorbed quickly while upside adjustments persist, not due to enthusiasm, but due to reluctance. The longer this dynamic holds, the more the market's internal logic drifts from its public narrative, increasing the risk of surprise when the two finally realign. John A.G. avoids framing this as a resolution point, instead treating it as an inflection that may only become visible after it passes. In that sense, what could come next isn't a single event or price level, but a gradual recognition that silver is behaving less like a trade and more like a constraint. For decades, markets have rewarded clarity and punished hesitation, yet silver now sits in a space where clarity is absent and hesitation is widespread, creating conditions that rarely persist without consequence. John A.G.'s analysis doesn't argue that silver must rise, nor does it claim that current prices are justified by any single force, but it does suggest that the market's internal balance has shifted enough to make old reference points unreliable. When a market stops responding the way participants expect, the risk isn't being wrong about direction, but being wrong about structure, because structure determines how quickly assumptions fail once they're tested. What comes next may look unremarkable at first, especially if price continues to move without drama, but that quiet progression is often how deeper adjustments establish themselves. Silver's behavior implies a market that is being managed rather than traded, navigated rather than challenged, and those distinctions matter more than targets or timelines. John A.G. leaves the discussion without certainty, but not without implication, because uncertainty itself becomes actionable when it's shared broadly enough to change behavior. If silver continues to trade as it has, the eventual resolution may feel less like a breakout and more like a recognition that the market has already moved on.